You, Tony, more than anybody I know, maybe Brian Belsky, a hat tip, have talked about the wall of worry personified by Mr. Baker and his good people at the Journal. The wall of worry is still there, isn't it?
Think about this statistic. So as of February, after the market kind of crashed in January and February, the percentage of newsletter writers, according to Investors Intelligence, that were bullish were 24.7%. The only two times that's happened in the last 30 years were after the credit crisis in June of 1994 and the Lehman crisis in 08. So you can have volatility, but those were two extraordinary times to be a buyer of equities.
You have kept people in play in the markets with your theme and your nuances over the many years. Is the wall of worry there now because Janet Yellen hasn't kept people in the market? We're not getting the verbal from her as she affects monetary policy?
Well, I think the idea that you have such negative global economic perception, and I think that's really the inappropriate time. I think it's more international. And yes, there is this, but we make it like it's Janet Yellen, Tom. It was the Greenspan put after 1994, after he doubled rates, corporate credit collapsed. It looked like you were going to go into recession 2 quarters in a row in early 1995 of 0.5% growth. Everybody got bearish on the internal bear market. Very similar to now. You go into June of 94, you make the low, and then you're off into the races. And I did an interesting thing when I count yesterday. If you could pull up, it'd be great. If you look at the S&P 500 from 1988 to, or 1984 to 1994, that 10-year period, there's no way you're thinking that 95 and 98 is going to happen. It looked like a market that was highly extended, overvalued, wasn't going to, so the whole point is the perception of the fundamental backdrop has become so negative, it creates opportunity. And, you can't, I didn't want to compound a mistake. I wish I was a little more defensive in December. So I don't want to make it like I'm constantly right, because I'm not. But you don't want to compound a mistake and get bearish at a low.
Francine, jump in here with Anthony Dwyer.
Yeah, the problem, Tony, is that I understand that you can be constructive and actually add to equities, but look at the world we live in. It's sub-zero. We have a great article by our Simon Kennedy saying we're getting used to this upside-down world economy fueled by cheap money, and this is probably what's giving an impetus to a lot of these equities. It's fictitious.
It's not fictitious because it's going up. And, Francine, I think, and again, I'm not buying the next tick. Honestly, I think the market's run a little bit too far, too fast. I'm a little more neutral on the near term. But any weakness, I'm a buyer. But think about this. Every time we talk about the market going down, well, the fundamentals are speaking to us. The fundamentals are telling you that the market's going down. And the market's telling you something. When the market goes up, how come it's never telling you anything? It's always wrong. The fundamentals are always wrong. So when you have negative economic activity, which we don't have, see, the whole key here to our view is that as long as there's lending in the U.S., which is about 25% of global GDP, in a service-based economy, you're going to march forward. Slowly at times, but you're going to march forward. You just need money availability, and we still have that, whether it's Janet Yellen or any other reason.
When's inflation going to pick up at a level that the Fed is actually content with?
I think, okay, so my view is ripple, wave, tide. When you think of the ocean, the ripple is kind of dicey as we head toward Brexit. I think the wave is going to be extraordinary. Your Rand analysis, I think, is spot on. You are getting a recovery in the emerging markets. So I think the next 6 to 18 months are going to be terrific. But to answer your question, I think the Fed's behind the curve. They're boxed in by the Brexit vote. You've already got accelerating recovering economic activity. I think you're going to have an inflation issue maybe 12 to 18 months away. The Fed's going to have to become more aggressive. So the tide has started to go out.
Right. Very quickly, financial stocks. Give us an update on your appetite for them. You've seen the earnings. You've seen James Gorman cutting costs, et cetera. We focus on J.P. Morgan, and we showed Deutsche Bank, struggling as well. But can you buy the banks, and particularly can you buy industry leader J.P. Morgan?
I think you have to. And the reason I say that, because so many people want to go away from it because the yield curve is flattening. If you think of the 2 times the yield curve flattened like it is, 2011 and 1994, 1995. Post both of those flattenings, without recession, again, without recession, you had an extraordinary outperformance of the banks.
Now, Charles Peabody, we should point out, at Portales Partners, looking at challenges here for 1 or 2 years, and then he suggests the major banks will mint money 3, 4, and 5 years out as well.